Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from the Quinnipiac G.A.M.E Forum in New York. Joining me for our first segment is Davitt. He's Partner Portfolio Manager over at Harvest Volatility Management. Thank you so much for joining us here today. Now, G.A.M.E stands for Global Asset Management Education, so it's focused around education for the finance majors here today. What does it mean for you to be at G.A.M.E, and what do you want the students to get out of it?
Well, it's really important that they get a broad knowledge of what's out there in the financial markets and what there's, I have a 19-year-old daughter and I tell her she may be into fashion, but there's also jobs in finance that have to do with fashion. So find an area that you're passionate about and then look into how that fits into the financial community. So you can be an analyst around a particular group of stocks that you really like, and also they should go to where it's not very popular right now. I ran derivatives at Credit Suisse, and I had a lot of young people out of college that would come and work for me. What I would tell them is, you need to look where you think what's going to be popular in 5 years.
Right.
Because for the first 5 years in this business, you're going to get so much stuff thrown at you, you're not going to know which way is up. But find something that you think will be fashionable in 5 years, not what's hot right now.
Well, that's where the growth is too.
It's where the growth is, and identifying them.
All right, well, let's talk about trends that you're seeing in the options market right now. And volatility has clearly made its way back in 2018. We certainly saw that in yesterday's session for sure.
We have. I mean, volatility is back for the first 2 months. People in financial markets tend to have a very short view of what happened 18 months ago. I tell people that there's been a 3 standard deviation, a tail risk event that's happened in the last 18 months, and can they identify it? And everyone will talk about February 5th or something, and I go, no, it was all of last year. So a VIX below 10 is outside of the 3rd standard deviation on movements in the market. There were all sorts of statistics. We haven't seen a market lacking volatility like this since 1950. So go back and study what last year was. Not so much, this is more of a return to the norm. And people can, there's interest rates going high, there's a lot of other stuff going on, but really last year was the anomaly. This is kind of back to normal markets. 700 points in the Dow yesterday seemed like a big number, but it was 2%. It was 1.5%. So on a percentage basis, these moves we should have been seeing these last year.
I don't think we saw a 1% move at all last year, or certainly at least 18 months. But so let me ask you this question.
Sure.
Would you say that the markets are more or less risky today?
I think that there is a greater sensitivity to risk now. I do think that there's been a dislocation of risk takers, right? So if you don't, I made up a term called an RTA, which is a risk transfer agent, and that's something that the kids might want to look into doing now while they're here. But like market makers or old school specialists, it's all been taken over by high frequency trading, and that provides great opportunity if you're more of a fundamental type investor. So what happens? The machines move away. I was at the bank yesterday at 4:45 at a retail bank, and then I heard somebody go, "Oh my God, the market was down 700 points today," which was something that I was staring at all day, every minute of the day. And they'll go home and they'll look at it and say, maybe I should put some money to work today. So the faster the markets get, the more volatile they seem. But we're on course for a relatively month-to-month low volatility equity market. I mean, S&P is up 2% for the year, or probably 1% after yesterday.
Right.
But that's a normal market. You're going to get these movements in the market, or as I like to call them, opportunities.
Well, let's talk about February 5th and going back to the short vol trade. Now, that was a massive blow up, and the short vol trade, it works till it doesn't work anymore. In a massive way. How do you feel about using short vol ETFs as a strategy, whether for the short or long term?
Well, short vol ETFs and ETNs, Kevin O'Leary's very clear that it's ETNs, not ETFs. I've been corrected by him. All of those exchange-traded volatility instruments, with leverage, without leverage, long vol or short vol, I warn people were created after the financial crisis. So none of them have really been through a stressed market environment. The most popular ETF, that was the short vol ETF, was up 180% last year. Now, if I came to you and said, I have a high yield bond and I have some leverage in it, and it returned 180% last year, you would approach that investment with measured, serious caution, right? Because up 180%, I mean, it can be down 180%.
Right.
Like, it's just the law of numbers. People did not have that education. I've been trading options for 30 plus years, and I can tell you this, we don't trade any VIX instruments in any of the funds that we trade, and we have over $12 billion of assets. You have to be very careful with exchange-traded volatility instruments. because nobody really knows, as was proven by February 5th, how they're going to react in a stressed market
Well, I
environment.
also think to professional options traders, they go into a trade, okay, what's my risk, what's my loss, versus, okay, how much money can I make? So to wrap up, my question to you
Sure.
is leverage really the boogeyman, right?
Absolutely.
And what can investors do to avoid common pitfalls?
People talk about risk, right? Like risk is a bad thing. Risk is a great thing.
Yeah.
You know, but you have to know that you have risk. You know, I tell the people the story. If I found a doctor somewhere to tell me that a bacon double cheeseburger for breakfast, lunch, and dinner every single day was not going to hurt me, so I blindly go ahead and eat bacon double cheeseburgers with a big smile on my big fat face, and then I realize. So then another doctor comes up to me and says, "Oh no, you're going to have a heart attack and die." Well, I should have known that that risk was there. I should have gotten a second opinion. So risk is great. Have a bacon double cheeseburger once a week if it really makes you feel
Right.
better about it. But be aware of what it's doing to you, and then do things to counteract that. Have healthier meals. The same thing with investing. Leverage is the boogeyman. It blows everybody up, from long-term capital up until February 5th. Every story in financial history of a blow-up has come from leverage.
Yeah.
So realize if you have it. It's the lack of knowledge of the leverage is what really takes people baseline.
All right. Well, thank you very much for joining us today.
Good to be here.
And traders, thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.